Hey everyone, Jeff Dorman, Chief Investment Officer at Arca, back again for another edition of That's Our Two Satoshis Live, where we talk about everything happening in the digital asset markets. As always, this is not investment advice, but we do talk about things happening in markets. And of course, you can always read our blog on our website called That's Our Two Satoshis at ar.ca/blog. Actually, this last week, though, I didn't write actually a lot about current market trends. It was a slow week. You had the equity markets down, up a touch week over week. Crypto markets fairly flat week over week. Not a lot of excitement happening. Really, the big news had nothing to do with markets, right? I mean, we're seeing mostly stocks up, bonds up, gold retreating a little bit, crypto kind of flat. Mostly what we are seeing, though, is this sort of rotation into these crypto equities, right? We've been talking about that for weeks, but whether that is your actual crypto companies like your Coinbases and your Circles and your Galaxies, or even sort of loosely affiliated like your Robinhoods, or even some of these Bitcoin treasury companies or other digital asset treasury companies. That seems to be where most of the demand is right now, while most of the actual crypto market itself is kind of languishing. And I think a big reason for this, and what we wrote about this week, is that I think we still have not found a true, deep, sticky investor base in crypto. And one of the reasons for that, in my opinion, is because we don't have the right methodologies for investors to make smart valuation decisions. We've been talking about this for almost a decade now. We're not alone. There's been others talking about methodologies, especially how to think about token supply and market caps. Not limited to, but including Blockworks and Thea and Pantera and Asymmetric, CoinFund, DACM, Modular, Defiance, Masari. There's been plenty who've been talking about this for a long time, but it's time to really go deeper on this. We wrote something about this maybe 4 or 5 months ago as well, talking about how you have to have new market cap standards because the way CoinGecko and CoinMarketCap and others are reporting the market cap is just flat out wrong. So for a recap, for those who don't know, if you go to like a site like CoinGecko, they usually list market cap and fully diluted valuation. Market cap is basically, honestly, in the traditional finance world, it's what you would call float, right? The market cap is based on the circulating supply. That's not what a typical market cap is, right? Again, in the traditional finance world, you call that float. What's available to trade is very different than market cap. And then you have fully diluted valuation, which basically just says we take all the tokens that could, in theory, ever be issued based on how much was minted at Genesis, and we multiply that times the price to get a valuation. Both of these are just wrong, right? They are just flat out wrong ways to look at valuation of tokens. And because of the nuances and way tokens have evolved over the years, it's starting to tell a really, really bad picture. Now, this really wasn't as big of an issue when we just had Bitcoin and Bitcoin forks, because again, I'm moving ahead a little bit. You might want to read the blog if you want to go into detail, but let's use a very simple example, right? Which is Bitcoin. Bitcoin has 21 million total supply of tokens. Everyone knows that. We all also know that even if some of them, a couple million of them haven't been minted yet, right, haven't been mined yet, we know there's a set schedule where they will, in fact, be mined one day. So when you think about how you value something like a Bitcoin, it's like, okay, well, 21 million tokens are eventually going to come, but there's only like 19.5 million or whatever the number is outstanding right now. Pretty straightforward, pretty easy to think about. There's just two numbers. Either the supply is that 19.8 million that are actually circulating right now, or it's 21 million, the total that could come one day. And again, that's fine for an inflationary protocol like Bitcoin with a set schedule. The problem is every single data provider, every single exchange has just adopted that same methodology, even though all of these tokens are now different, right? We have different token issuers, we have different token structures, we have some inflation, some amortizing with buybacks. And ultimately, as a result, all of the ways that these are being reported are just flat out wrong. And CoinGecko and CoinMarketCap and all the exchanges, once again, just turning a blind eye to what should be the listed market cap and supply. So in the article that we wrote about, we are trying to call on all participants to change this to something called adjusted market cap. And we'll get into the methodology in a second, but ultimately, there's a lot of things that crypto does better than TradFi, but this is just not one of them. The TradFi way of doing it works totally fine. There is a set number of shares, for instance, that a company can issue. Those are the authorized shares. But not all of the authorized shares are included as part of the market cap, right? It'd be the equivalent of authorized shares being something closer to what we think about with FDV, meaning the total possible that you could issue. but it's not what anybody uses for valuations. You don't include all of the tokens that have yet to be issued or are owned by the treasury of the company. That's just not part of market cap, right? And then, all the way down to the float of a stock, the float being the number of shares that are publicly trading. This excludes closely held shares by insiders and executives. It excludes locked tokens. That's part of the float. But nobody uses float for any valuation techniques. What they use is market cap, right? Market cap is based on outstanding shares, which falls in between the free float shares and the authorized shares. That's how people use for valuations. And that's what crypto needs to do as well. We need to come up with something that is in between what's being listed as market cap, which again is really float, and the FDV, or fully diluted value, which is more like authorized shares. No one has really come up with an adjusted market cap that takes into account what should be included when you're thinking about valuation. And what we did in this article is we set out to define that, right? Float has to be less than or equal to adjusted market cap, which has to be less than or equal to FDV. Float is going to be based on the circulating supply, meaning what is actually tradable. So that excludes your locked tokens and tokens that are in treasury. Adjusted market cap, which is what we should be using for valuation, is based on outstanding supply, which we'll define in a second. And then fully diluted valuation, which is based on max supply. So we put a table together in the article just talking about what are some of the things and are they going to be included in float or adjusted market cap or FDV. And ultimately, the way we've been thinking about this, I think will set everyone up for more success when we are trying to define what a company or a project is worth. We'll give a few examples too in here. We already talked about Bitcoin, but we look at something like Athena. Athena has a very large max supply, and based on that max supply, you could come up with a fully diluted value of like $4 billion. But the float is tiny, right? This is another one of those low float, high FDV projects. The float's only like 700 million. But if you actually include all of the tokens that are owned by core contributors and all the tokens that have been sold to investors that have not unlocked yet, the actual adjusted market cap falls much more in between, around 2.2 billion. And that's what you should use for evaluating something like that. 2.2 billion, obviously a very different number than 4 billion or 700 million. And I think this discrepancy is really holding this industry back because investors just don't know what to do. Hyperliquid's another good example, right? Probably one of the more polarizing discussions among analysts in the kind of crypto hedge fund world, because again, a massive discrepancy between what is being reported and what reality is. So you look at Hyperliquid, which has been buying back roughly 97% using 97% of their revenues to buy back tokens, but they also have a lot of tokens that are set aside for future airdrops and community rewards. So again, if you look at just the max supply of 1 billion tokens, that's going to give you around a $40 price for hype. That's going to give you about a 40 billion FDV. But that's insane to use for any valuation because the majority of these tokens are never going to come out or not going to come out for decades, if not centuries. Things like the future emissions and community rewards, which have not been defined yet. Not to mention, it doesn't include all the buybacks that the company is doing with all these tokens that then sit on the company treasury. Similarly, if you just look at the float, you get like 12 billion. 12 billion is a vastly different number than 40 billion, but it's also not very accurate because it doesn't include the tokens that are held by current and future core contributors and the budget that they have. Again, and it also doesn't exclude the buybacks. So we come up with an adjusted market cap closer to 24 billion when we look at Hyperliquid. So these are massive, massive discrepancies, and it should not be hard for the industry to get on the same page of what these true valuations are. If you look at a company like Hyperliquid that's annualizing close to $1 billion in revenues, it's obviously a much different story if you're talking about that at 40 times sales using max supply or 12 times sales using float versus what we think is closer to 23 or 24 times sales using the actual adjusted market cap. And then you can get into, we have all kinds of other examples in there like SWE and Celestia, et cetera. The reality is we are pretty certain that this is the right way to do this and that we need to do this in a way that is standardized across the industry. The question then is, how do you actually do this? Because some of the information needed to calculate this type of data accurately is difficult to obtain and figure out because a token can be publicly traded without disclosures set forth by regulators. It's really, right now, it's up to the token issuers or the data providers or the exchanges or just community members like ourselves to accurately get this information out to the public. That's not a perfect system. So what we need to do is create a standard that everyone agrees on for what is included and excluded in adjusted market cap, similar to the table that we laid out in the blog, where we talk about everything from community rewards, airdrops, ecosystem allocations, grants, R&D, investors, advisors, team core contributors, buybacks, etc. List everything that could possibly happen with a token, and let's define whether or not it's part of the market cap or not, so that these data providers and exchanges can put the right information out there, right? And if enforcement is not possible, then social pressure needs to be applied so that the entire industry can warn investors not to touch tokens that don't transparently update the information proactively. So this is an incredibly important data point. It's an easy standard to adhere to. What we have to do is agree on it and get the exchanges and the data providers to put this out there in the right way so that we no longer have to guess and that investors no longer shy away from the space because they don't know what the numbers are. If you go to TradingView or you go to Bloomberg or you go to Yahoo Finance, you're going to see the exact same information when you're looking at a stock or a bond. When you go to CoinGecko and CoinMarketCap and Masara and everywhere else, you see totally different numbers. And that's not okay. It doesn't work. It doesn't work. It's going to keep people away, and it's hurting the industry. So anybody listening to this, if you care about talking about this, reach out to someone at Arca. We're going to try to put together a consortium. We're going to try to figure out how do we come up with a standardized methodology for outstanding supply that leads to a standardized methodology for adjusted market cap so that we can get this right. That's it for this week, guys. Appreciate you listening. Please check out the blog. You'll see a lot more detail and a lot more examples on our methodology on our website, ar.ca/blog. And we'll be back next week, hopefully with some market moving information. Thanks, everybody.